The upper left-hand corner is my 15-minute time frame. The lower left-hand corner is a 5-minute chart. And then the upper right-hand corner is a 1-minute chart. And for teaching purposes, and to answer a few questions that came up from my private mentorship students, how to hold on to a trade and or how to look for um, additional entries if you miss the ideal one that would be on the 1-minute chart. So I'm going to give you a little bit of lesson on the price continuum, price delivery continuum theory, which is where we go through all of the time frames and all the time frames, as I mentioned yesterday. This is it. I'm not using anything higher than a 15-minute time frame because it's intraday trading. You don't need a daily chart. You don't need an hourly chart. You don't need a 30-minute chart. You don't need anything above a 15-minute time frame. Yesterday, I talked about the process of not going above a 15-minute time frame. And I know some of you that have a higher time frame affinity for like a daily chart, weekly chart, and whatnot. That probably feels very uncomfortable hearing that. And I've said this before. Um, you don't need all those time frames. Now, when you have a model that you're risking money behind, it's important to refer to those things. But right now, the only thing you're trying to do is get familiar with reading price action and getting over that fear of missing moves and fear of not knowing. The fear of not knowing what's going to happen next, it's an enormous sense of, well, it's like a barrier. You feel like you can't break through this invisible force field of, I wish I could know what it's going to do next. Because if I could just do that, then I could be profitable. And I'm telling you, that's not true. That's not true. But it has a necessary role in your overall development, and it needs to be the first thing. Where's the market likely to move directionally? Where's it going to gravitate to? And what time usually will these moves form? I introduced a very generic form of that yesterday. A 15-second chart, just I'm going to say this and then we'll get into the business of the 15, 5, and 1. The, the advantages of a 15-second chart is that I can get into a price run that I missed on a 1-minute chart, a 5-minute chart, or 15-minute chart, or any other time frame that I may be looking at. But for the rules that I'm placing on you, Caleb, these are the only time frames until I tell you otherwise. You're not looking at anything else. So don't send me a daily chart. Don't send me an hourly chart. Don't even ask me questions about any other time frame ever until I introduce some other reason for you to look at another time frame. Because this universe right here, okay, this whole solar system of price action is all you need. You don't need anything else. But the 15-second just simply gives you more opportunities to get into a move that's underway. That's really all I'm saying. Or to dial down and reduce the risk and the exposure of a stop loss that would otherwise probably require much more handles or pips if you're referring to Forex. It can be reduced very small because you're looking at a 15-second time frame. Now, don't think for a second that the 15 seconds just answers all the equation and problems of larger stop losses, because if you don't know how to read price action and if you don't know what that 15, 5, and 1's doing, just because you looked at a 15-second, some of you are thinking, oh, he just gave me the shortcut. There's the shortcut. All right, ICT's the plug. Like, hey, he just gave us the secret. This is the golden ticket. Don't look at anything else, folks. Everything else is distractions or red herring. 15 seconds is the answer. Let's go into the business. All right, so if you go over here and you look at my 15-minute chart, I know that's a really long monologue, but you have no idea how many questions I get and how those types of segments of my delivery removes a lot of headache because people get mad at me like I'm ignoring them and their questions, and it's not about you, bro. Okay, you're not the only person I'm talking to. And the 15-minute time frame, what you're doing is you're looking at time first. And let me first cancel out the confusion I probably caused some of you. So here's 7 o'clock in the morning today. All right. You want to put a vertical line on that. It doesn't need to be a very bold color or anything like that. You want to just be able to annotate 7 o'clock. Okay. The things I mentioned yesterday where I said you want to start at 7 o'clock in the morning. That's true, Caleb. You don't want to look at anything prior to 7 o'clock because you are not versed in anything with the London session. I'm not expanding your focus and time beyond the scope of 7 o'clock in the morning, New York local time. That's your punch in time. Okay, that's the earliest you can refer to in price. If we look at, now pay attention to this, okay, because this is going to answer the confusion I caused yesterday without really wanting to. At 7 o'clock in the morning, that begins your hunt for relative equal highs or relative equal lows. What I meant to say, but I wasn't very successful or articulate in the way I said it, is when I was referring to the London session, you do not, this is the part where I said this is really important, this is key takeaway information, do not look for your relative equal highs or lows prior to 7 o'clock, Caleb. That does not mean students that have learned models from me in private mentorship that they shouldn't be doing an observation on these relative equal highs. Because if you're looking at prior to anything at 7 o'clock in the morning, what you're really doing is you're referring to London sessions price data and its profile, not market profile where it has the volume, horizontally, okay, like it's something special. That's not what I'm talking about. Market profile is it making the high or low of the day in London? Is it setting up a consolidation to expansion trend day? Or is it going to be just a trending day? Is it seek and destroy? All those profiles I taught, they're on my mentorship videos on this YouTube channel for free. You don't need to pay for them. You don't need to go to somebody else's 5-minute trainers. And I promise you, they don't know how to use them either. This reference point at 7 o'clock, if you know how to trade other price action models or ideas that I taught, and you've been with me as a student for a while, and you do trade London setups as a continuation or a potential reversal for a New York session market reversal profile, where what that means is the London session between 2 o'clock and 5 o'clock in the morning Eastern time, that's New York local time always, if that session time has seen the market drop like we see here, okay, if there's going to be a New York session market reversal profile, that means that they're most likely going to see price trade back above and overlap all of the movement that was started at 2 o'clock in the morning here. Well, if you're a brand new student of mine, or if you've been familiar with some of my videos but you just feel confused and you've never been able to find a footing on how to start, where to begin, this is what I'm teaching that to my son Caleb, because he's in that same boat. He has familiarity. He's had Top Step account. He's done all that stuff, but he hasn't seen consistency, and he doesn't really know what he's doing. This is what I'm going to do, and I'm only going to do this. So what I'm trying to do is I'm stripping it down to the chrome and saying, this is what you focus on. You start here. And then when he shows me by his progress that he understands what I've given at this point here today, then I will expand his circle of focus and his intentions on other factors of time. But you don't need anything. Honestly, you don't need anything extra outside of today's stuff, what I'm going to teach today. So in clarity, if you are a trader that understands day of the week and time of day and London session trading and how it can communicate a potential continuation or reversal in the New York session, you should have been fine with yesterday's commentary. But for the folks that don't understand how to trade the London session and how to integrate that with the New York session and how it works together to make the daily range, that could have caused you a great deal of confusion. And I did. I saw a lot of folks in the comment section saying, you kind of like, you made two statements that are opposed to one another. At one point you say, look for relative equal highs and lows prior to 7 o'clock in the morning. And what I'm talking about is for anyone that wants to look at the London session and you understand daily range and you understand all the other things I've taught and you're more of an advanced trader using my concepts, you can look for setups prior to 7 o'clock in the morning. But if you're brand new, don't even worry about that right now. Trust me, you don't need anything else prior to 7 o'clock in the morning at all. So for clarity's sake and simplicity, and to remove all the complications that you probably thought that was being thrown in there, At 7 o'clock in the morning, what you're doing is that's your beginning of the day. You're now starting to look for relative equal highs and lows. And you start on what time frame first? The 15-minute time frame. Okay. So this starts the hunt for at 7 o'clock. Did we create a relative equal high yet? No, we just have one singular high. Do we have relative equal lows? Don't look at this because it's before 7 o'clock in the morning. Don't do that. Don't even refer to it. The rules are very simple. You're waiting to see relative equal highs and relative equal lows form after, post 7 a.m. New York local time. Now, these two lows may be a factor for the 5-minute chart. So we're going to go to the 5-minute chart and expand that. All right, so now we do potentially have, if this starts to rally, we don't have it yet, this could potentially become relative equal lows. Now with that, all you're doing is you're making a mental note of it. You're not annotating your chart because it's not there. You never, never, never lead your expectations with something that has not actually formed in the chart. Don't predict the setup. You have to wait for the setup. You have to wait for these signatures to form in price. You cannot anticipate them. You don't know what you're doing yet. I can do those types of things. You've watched me do that with calling inversion fair value gaps before they actually formed. And people insisted that it was after the fact, annotations. It's not. Post 7 o'clock, you're scanning through, looking for relative equal highs and relative equal lows. We can't refer to that low because it's before 7 o'clock in the morning. So we go down to a 1-minute chart. I'm just going to toggle through on the chart itself. And here is the 7 o'clock delineation. And you're looking for relative equal highs. Now, these have already happened, okay? So that's something that you could have observed at the time at 7 o'clock in the morning. We weren't here, obviously, at 7 o'clock. But it ran through there. So what did this do? Okay, think about what I was talking about yesterday. There's two different characteristics in price delivery that is a very, very simple perception of what price has done. It took an area that's smooth and made it jagged. So what happened here? This was an engagement for liquidity. So what did it do? It took buy side. After it took that buy side, where did it go directionally? Lower. So if it's done this type of work, then you have to go back through this price leg from here down to there. See that? So what you're going to wait for is something after 7 o'clock in the morning to create relative equal lows. It could rally up, and then these relative equal lows could be the setup for a run lower. And if it goes below these relative equal lows, and I'm not saying it's there yet because I'm not trying to push that on you today, but these are the things you're doing as you're watching the chart. You're observing and referring. So if these become relative equal lows and it rallies higher than this high here, these become relative equal lows. And if it wants to go below that, how far can it go? Refer over there. That's not the same thing as looking at relative equal lows before 7 o'clock. You're just looking for liquidity for the sake of just simple liquidity. And you're referring to how far can it go beyond relative equal highs or relative equal lows. You got to look at market structure outside this parameter. But initially, all you're looking for is to get a draw or a short-term bias on a time frame, whether it be 15, 5, or in this case, 1-minute chart, where it affords you movement. You're watching to see how it attacks or tracks to a relative equal low or a relative equal high. We already see that they've done some work up here. There was a shark frenzy, okay? There's blood in the water up here. We don't want to trade up into that. We don't want to trade into this because they've already done a lot of things in here. So what we're doing is we want to see it try to make an attempt to run out some kind of a relative equal low. That's what you start with. It doesn't mean you're right. It doesn't mean it's going to pan out. It's just that's what you start with. That's the process. So you work from the 15-minute time frame, look for relative equal highs, relative equal lows after 7 o'clock in the morning. Even if you see them obviously right before 7 o'clock or during the London session, ignore them. All you're trying to do is learn how to encapsulate price action. If this price, say all this price action here was over the course of, I don't know, 15-minute time frames or 30-minute time frames, and this was the close at 4 o'clock in the afternoon New York time. What that would indicate is that this was the daily range. It created the Judas swing here, it dropped down, and it came off the low to close near the low of the day. That's power 3. You're going to discover that every single time you sit down and you look at the AM session, you're essentially looking for that to form. You're looking for some fake manipulation that creates all this animation, and it does the harmful work of hurting people and putting them out of a trade that would have been profitable or putting them in a direction that's not right. And now they're trapped long in this case, and then they rake them across the coals and drop it lower. So you're looking for where the retail or street money trader is going to be, or less informed trader, they're going to be looking for support and resistance. I'm not a support and resistance trader. I don't teach my students to trade support and resistance. We look for liquidity and inefficiencies. And when you go through the process of looking for all of the relative equal highs and relative equal lows on the 15-minute, the 5-minute, and 1-minute chart, once you have either panned through and either identified what's available on any one of those time frames, or if there is none that's obvious, then what you do is you go through your charts and you annotate all of the inefficiencies. And we're going to work our way back up. So right now we're on the 1-minute chart. So this would be like this. You see this. There is no volume imbalance in here. So you're going to start right at the candle's low, drop it down to the very next candle after the big long down close candle. What kind of candlestick fair value gap is this? It has a down close. What did I teach you yesterday? A down close fair value gap is a SIBI. Stands for sell side imbalance, buy side inefficiency. That means it offered delivery on the downside. It's inefficient in any movement back up inside that same range that creates this one single pass through until you get into this area here. So that's the furthest we went back up into this range right there. So it's inefficient by characteristic and definition. Anything above this high up to this candlestick's low right there, that candlestick's low. All of that is inefficient and is inviting the opportunity for price to want to trade up into it. Doesn't mean it's going to happen right now. Doesn't mean it's going to happen this session, but that's the characteristic. Then you have this one in here. We've already worked this one there. So there's a small little section between that candle's low and that candle's high. Maybe you didn't see it. Maybe you did. If you didn't, don't beat yourself up about it. I've been doing it for a long time. But your eye will jump to these little gaps and these small little inefficiencies where they may seem insignificant to you right now. Like, really, why would you even highlight that? That's like nothing. Meaning that from this candle's high and that candle's low, essentially this is what's remaining in that little small section. And I'm telling you, I've entered trades and recorded myself doing it with real money and shared it with you where I've used levels just like that and placed limit orders just below it to get filled, and it never has any significant drawdown and just runs and takes off, goes to my limit order for a target. If you're a student of mine, you're in private mentorship, you've seen some of those things lots of times actually. And then over here, this inefficiency, let me fix this because I always want to refer to the original fair value gap, but noting what level of inefficiency is still available. That means the small little section between this candle's high and that candle's low right there. So I always keep the original fair value gaps, the levels, because they're key. They can be used again. They're influential. It's not so much that I'm only looking for the remaining unfilled portion. I am aware of seeing that because I can see the difference between the high of the fair value gap and this high of that candle. So I'm not trying to make any special distinguishing note of it. But in my mind, subconscious, I know that if I'm going to go back to that, it may go back here just to tap the high of it, and that'll be it. Or if it goes above it and comes back down, then I could use this candle's wick and the halfway point of it. That's how far I can retrace back down into it, and it becomes an inversion fair value gap. When I have a candlestick like this, okay, when you're annotating your inefficiencies, we have this one here. There's no volume imbalance up in this segment to here. Is that accurate? Look closely. What's wrong? The low of it needs to incorporate that volume imbalance right there. The volume imbalance is the separation between one candlestick's body and the very next subsequent candlestick. If the bodies don't overlap or at least touch, there's a volume imbalance there. I'm quite certain you're not going to see any information about that unless someone else wrote a book about my concepts. And this is new stuff. Okay, I introduced it to the community, and it is very, very influential in terms of reading price action, in terms of precision elements. You have to incorporate that. That is your fair value gap. Why? Because the wicks are not the true narrative. That's where the damage can be done. It's like your child that colors with a crayon in a coloring book. They color sometimes outside the lines. You know that they messed that up, but you're not going to sit down and say, look here, Billy. I don't know how many times I got to give you this lesson, but you will not be eating dinner tonight because you colored outside that picture again. Sure. You'll do a better job next time. But right now, it's no dinner. You're not going to treat your son like that. If you do, you need to get stomped. But if you see your child do that and it colors outside the line, what do? Oh, he colored a picture for dad or mom, and you put it on your refrigerator or you take it to work and you hang it in your cubicle. Because you're proud of him, right? Because you know that that's just an aberration. It's just something that just happened and it's not a big deal. Well, that's how I look at wicks. Yes, the algorithm repriced up into there a little bit. That's fine. Where's the body? Right there. So volume imbalances here. This is the stuff you're supposed to be writing down, folks. If you're just listening and eating potato chips, you're completely oblivious to what's being introduced to you. The volume imbalance tells you to ignore any of the wick. This wick will not be all that influential. Whereas if you were without a volume imbalance in here, let me zoom in because I really want you to see what I'm talking about because I'm not sure if you can see it well. Some of you guys are trying to learn this on your smartphone. And I've got students in prison that are studying and they're like, man, I wish you could zoom in. This brother just read my mind. How do you like that? So that's the volume imbalance right there. Okay. So if you have a fair value gap or an imbalance and it has a volume imbalance in it, any wick inside the fair value gap just completely nullify any intention on that. Now, find that in your textbooks. Find that in your rip-off ICT mentorship 5-minute trainer guys. They're not going to tell you that insight because they didn't make it. So the volume imbalance right there, that tells you if you have that and any wick in there, just completely disregard it. Only if it's a wick that's below the consequent encroachment, which is the halfway point here. So any wick that reaches up to that level or less, ignore any of those wicks. You have to take it to the body of the candle. Okay, so that gives you the true, real fair value gap, or in this case, a SIBI, sell side imbalance, buy side inefficiency. All right, so that's the business there, and extend it out in time. And the market goes right up to that high and then folds and creates what right here? What is this? That's that fair value gap between this low and this candle's high. And you see it trade right up into consequent encroachment plus a little bit more. Why? Why? Because the algorithm is affording anyone that uses this information, that uses this level as an entry point, they have to offer them the spread, right? Or they won't get their fill. And that's why you get this little bump right above right there. You want to go through the charts and you want to highlight these things. And since we have done this work up here, where we had relative equal highs here and here. What did I teach you yesterday? How do you know it's a high probability relative equal high? When the right side that is identified as a potential turning point for a quote unquote potential relative equal high, the right one is going to be slightly lower than the one on the left. We have that here. We don't even need to see this ahead of time. We just need to see, okay, it ran that, and you might identify it after it does that run there, and then you start seeing it break down. See that? At the turning points or potential turning points like this, okay, this is where, and I'm going to refer to this in my book with this lecture here. I've taught and introduced inversion fair value gaps on Twitter Spaces last year, okay? All of my PD arrays have an inversion aspect to them. Every single one of them. Every single one of them can reverse their role. Every single one of them. But it's not easy for you, and it's not easy for people that want to try to teach my stuff for money when you're actually getting it right from the source here for free. It's not easy for them to be able to teach that because I've never went into great detail like I will in the books. So that way it kind of like bridges the gap. And then you'll see everybody start teaching it then. But this is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on your understanding of what I taught you yesterday and what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? I taught that on baby pips back in 2011. Yeah, I think it was 2011. If it wasn't, it was 2012. The idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a SIBI. A up close candle right here, this is the opposite, which is a BISI. B-I-S-I. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time, Dave, and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. And then it's to your detriment that it reverses and collapses on you. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs. It rallies after, remember the new week opening gap I talked about yesterday? You're going to discover, Caleb, that your model is going to be gravitating towards those new week opening gaps. That's your model. You're going to be trading in that direction. But before we get to that, you have to be able to look at small fluctuations around segments of time that will have a repeating phenomenon, that they all look very similar to one another. It's a fractal, okay? But the fractal element is only repeating and verifiable on the time frames I'm teaching you to focus on right now. We're not going anything higher than the 15-minute time frame. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal where everyone else that thinks they understand it because they've been introduced to it lightly, that is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. Now, I'm going to slow things down here because I already know some of your heads are spinning. You're like, dude, you said this is going to be easy. You're not complicated. What I just said is not complicated. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price, because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this. But my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there, and they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there, that right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And now what do you have at this point? You have this low and this low. And what time of the day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias, because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information, my head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It's just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. You'll see them kiss them, turn on a dime, go right to the level, stop, turn around, the bodies of them stop. Like it's so precise. It goes without question. It's laughable for anyone to say there isn't an algorithm. These price engines, what are they referring to? Think about it. What are they referring to? They have, if it's an algorithm, it has to refer to something it's happened in the past. So what I've done is I've created a language where you're either going to be reaching for old highs for the express purposes of taking out or engaging that liquidity that would be resting above it in the form of buy stops, or going below a low or equal lows for the express purposes of going down to engage the sell side liquidity or sell stops. Outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point because it's going to trade right back up into that. And if you go back and look at your examples, maybe you've taken trades, whether it be live, demo, whatever, or maybe you've done some annotations and chart work and journaling, and you were focusing on studying on the breaker. Go back and see if this signature doesn't appear in some of them, and maybe some of the things that you would have taken as a trade there, or maybe you've taken and got stopped out. This was the factor that you didn't see it happening. And notice that this is the only buy side and sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is likely to change bullish. Your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that question a lot, even with private mentorship students. How did I pick that one? Why did I pick that one? Why didn't I pick this one over here? Well, that comes with experience. And it may seem like a cop-out to some of you to do straight ass hats and you don't really want to take the honest truth. There's some things that you're going to have to get with experience. And I don't make any bones about it. I don't sugarcoat it. And you're going to pick it up because you've been doing it long enough. But to get that experience that's required to do a lot of things that you're asking for answers, you got to do what I'm showing you here. And you can do it after the fact. You can go back and look at it. And yes, you have the added benefit of hindsight. Don't discourage yourself in that. Because anything you learn, every surgeon that ever did a surgery on you, they studied in a book. They watched other surgeons do it first. Then they worked on a cadaver. It's a dead body, okay? Where if they cut some artery or something, they make a mistake, the person's not going to sue them for malpractice or die on the table. They're already dead. So they're demo trading with a corpse, okay? Or they're demo surgery with a corpse. But when you start looking for it, there's specific fair value gaps, Caleb, that I want you to focus on, okay? The very first fair value gap prior to a stop run, always have that one noted. And that's why it's colored red here, or pink if you want to call it that. Because this is a change in a direction. And what this is doing is acting just like an order block. It's just change in the state of delivery. Oh, so I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt. Okay. There's going to be lots of times where this doesn't form, and that's okay. If it doesn't form, what do? Throw everything out the window and start trading supply and demand and Elliott wave because nothing's going to work for you. I had to toss that in there. I had to toss that in here because some of you are falling asleep. You're like, oh, dude, he's droning on. I don't know what's going on. This fair value gap, okay, if it's not there, then you use the breaker. It's very simple. It's the last down close candle, okay? But your stop needs to be above the highest high of the consecutive down close candles because this is all the bearish breaker, both of these candles here. So your stop has to be above that, okay? How much? Oh, two ticks maybe, one tick. Many times I've used this the high because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has the stop hunt, because if you have that, then you could potentially see a whole return back up into this and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I tossed that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then this is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. So you want to key off of and look for turning points or what will be future entry points for you, Caleb, for trades that key off of these sell side imbalances, buy side inefficiencies. Every single SIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one. Because there's stops above that, okay? We already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here. It traded down through that. And then we had all this business in here. We swept below that here. Actually, it's kind of sloppy, isn't it? Every sell side imbalance, every sell side imbalance. Don't see anyone in here. Yeah. Notice how this one here, what is this one? What's this? What's this fair value gap? By classification and name, what would you call that one? It's a buy side imbalance, sell side inefficiency. Okay. I'm not looking at that one. I won't highlight that one. I won't extend it forward because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Like it could do it here. I'm not saying it will, but if it did something violent and started to reverse, then I would draw my attention to this one because then I could act on that as an inversion fair value gap because it would reverse its role. But right now, when the narrative is in motion, every sell side imbalance, buy side inefficiency, I'm referring to. I'm not always drawing them out on the chart because, as you'll see, it can be rather busy on your charts, and I like to keep things naked but not afraid. And you can see it trading up into the consequent encouragement of that one. So when you're trading, or not, sorry, when you're observing price action, you're spending your time not pushing a button trying to trade. You're not trying to convince people in live chats in their chat window. You're not trying to tell influencers what you think is going to happen because you're going to wait for a high five, like, yeah, bro, or yeah, sister. None of that stuff. You're in your own little bubble every single day, and you're looking for these things to unfold. Now, if you recall, I mentioned yesterday. Let's do that right, Michael. Come on. At 8 o'clock is the same thing. There's another point of confusion I want to clarify. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range. Okay, it is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low or a price run lower. What is that by definition? Opposing directional run that's against where you think it's directly going to go. That's a Judas swing. That's manipulation. It's something that goes against the grain of what you're expecting, not what everybody else on the internet's doing, but what you're expecting. Okay. If you look around yesterday, everybody's titles on YouTube had stock market crash, and I was in here telling you it's going to go up. Was that random? No, because everybody had the same idea. And I sat down with you, explained to you this is what it's going to do, and we wait for it to present itself, and then we put in motion a plan of where the next foothold or the next grab point, like rock climbing. Okay, a rock climber looks at the surface of the cliff that it's trying to climb, and he looks or she looks and tries to map out a pathway. Okay, I am not going to just reach up for this grab point here with my hand and pull myself up a little bit and then guess where the next handhold is going to be. They try to map out because they don't want to get to a point climbing up using all that energy and then find out they're really not in a position to grab onto something that's more efficient for the climb to go back up. Well, in this case, we have a descent. Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning, if this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it and then resisting and going lower as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your 3 windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these 2. Right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level. But now you do. You have a stop hunt. The market broke down. So this is a shift in market structure. Okay. And this is a optimal trade entry. Even if you didn't have all the stuff I'm teaching you here and amplifying it, you already know this. This was the flagship pattern of my channel since 2012. The optimal trade entry. A shift in market structure. Measure your high to your low. 60 to 72% retracement. 62 to 72% retracement level. And 70.5 level. Each hour at 7 o'clock, in this case 8 o'clock, and at 9 o'clock, what you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows because you're trying to work inside the range of the morning session. Okay, and the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. I like to be done by then. Frankly, I like to be done by 10:15, 10:30. You know, if I can get something on and be paid out, I'm done. I don't need to do anything else. You may not like that. You might want to be for the whole day. Not me. I don't want to be in front of the charts. I don't like to be chained in front of the charts. But once you have a turn in the direction like this, and the market's likely to draw lower, you'll see that by focusing on only one side of the marketplace with the inefficiencies, as we have here, it's moving lower. So every SIBI is extended to the right. Okay, if you remember on Twitter, I would tell you note a specific fair value gap, and I'd say extend it to the right. That's this. That's me doing this here. Okay, and whenever you see the market trade, through them a little bit, you'll see a troll or someone that has no idea what the hell's going on. They'll say, "Oh yeah, he thought it was going to sell." That's not what we're doing here. You're going to wait for it to cover over top of it and then break back down through it, and then it will act as what you expect it to do. Many of you, when you see me talk about inefficiencies, fair value gaps, SIBs, BISTs, all that business, um, you anticipate that, oh, it's a matter of just going up. Once it gets into here, all you got to do is sell short right there. That's not it, folks. You have to anticipate a measure of manipulation. What was the price doing here? I told you it was getting kind of sloppy. We had this inefficiency, yeah, but what else is there? What else is there? You have this energetic drop that created that SIBI, and there's going to be what trailed there. For anyone that's short, they're going to put their stop loss right there. Well, that efficiently been removed with this bump here. Back into an old SIBI, and then you have a market breakdown. Look at the work around the halfway point, which is consequent encroachment. The market drops, opens again here, breaks lower. We have an inefficiency. The bodies are telling you, yes, this is going to go lower. Why? Because it stops right there. See that? The wicks are allowed to do what? A little bit of damage. Is it going to random locations? No, it just bumps the bottom of that SIBI over there. Right there. And then works lower. Now, at 9 o'clock, the same thing. You can look at any relative equal high or low prior to 8 o'clock up to 7 o'clock. If you're going to be trading with longer term price runs, for the folks that are asking me, how do you hold on for longer trades? In that case, you're going to have to look at the previous day's range and what is the previous day's low, or if it's going higher, what's the previous day's high, and that's your next logical level to reach for. But I don't want to give Caleb anything beyond the scope of what I've already covered, because it's giving him way too many things to worry about. And if you're brand new, you're probably feeling that too. But in short, what you're doing is at 7 o'clock, that starts the hunt for relative equal highs or lows. If you see a disruption like we were talking about yesterday, where it's jagged, you see how it's nice and jagged? That's indicating it's probably going to go the opposite direction, especially if you have all these other supporting factors where that would have been a breaker. This is obviously a high probability inversion fair value gap, and it hits it here, respects consequent encroachment, breaks down, and then we have another return in here. Here's the optimal trend entry as well. And everything is, your mindset is, okay, I'm looking for lower, I'm looking for lower, I'm looking for lower, and it breaks lower. And then you highlight every single time it creates an inefficiency where it's a big candle that doesn't have any overlapping with the candle prior to it forming or the candle after it. So it creates that inefficiency, that imbalance. And then when you have these long protracted consolidations like that, it's really better for you to sit still. Let them do whatever they're going to do. Why? What do we have there? What did I say yesterday? We have relative equal highs and we have relative equal lows. You're going to be playing the breakout game. And I'm not a breakout artist. I'm not trying to guess. I want to see what the market's going to do. So by this run up, it can trade into any one of these fair value gaps in here. It does. And does it fall out of bed? Yep. So what I would require, and you've heard me say, well, not technically you heard me, you'll see in old tweets where I'll say, we want to see this fair value gap as an inversion fair value gap. Well, that means it ran above it. It's got to go below it and then do this right there, that function of redelivering to it. Then a deeper protraction lower to upset any liquidity that would be resting below here, as much as, and to the degree of reaching down into that low over there, because that's the low in London. You see that? So when you have your charts, Caleb, I'm only interested in seeing anything before 7 o'clock if the range of the morning session trades to the London session low or the London session high. Other than that, I don't want to see anything on your charts beyond this. Okay, that's it. So all your charts are going to have about 6 o'clock or so, just to get a little taste of what London was doing. And then everything else in your charts needs to be very, very simple. But I want 9 o'clock delineated, 8 o'clock delineated, and 7 o'clock delineated. And any formation of relative equal highs or lows, I want you to annotate them. The relative equal lows and the relative equal highs. I said yesterday, when you have both of them, you wait. You wait for them to take one side out. What does it do? It runs higher. So what's it going to attack now? That one. And it runs down below it. Okay? So as it is right now, if there was any trade taken or no trade taken at all, you would do nothing because it's already done a whole lot of movement and it's back in an area where I wouldn't want to see it as a trade back in this civvy again because we've already done once, twice overlapped it, respected it, and now we're back inside of it again. That is low probability, and it could fall out of bed and crash 1,000 points a day. It still wouldn't be a trade I took because it's against the rules of me wanting to use it. It's been overlapped and worked multiple times, and it's done enough. So your day would be complete here, and you would capture everything just like this, and then you would annotate it. Like this would be an area where you could highlight or type out any observations or what you felt about this movement here. In this little area here, you would annotate in text. You have to have an expectation on price at a time of day. In this case, you have 3 specific times of the day. And the first 30 minutes after 7 o'clock, after 8 o'clock, and after 9 o'clock, if there is relative equal highs or relative equal lows below the marketplace, then you want to see a move the first 30 minutes go in the opposite direction up. If there's relative equal highs that form after 7 o'clock, after 8 o'clock, and after 9 o'clock, that first 30 minutes, you want to see the market drop. You want to see a measure of manipulation. It doesn't have to only be in that first 30 minutes. But in my mind, I'm thinking, I want to see that. And if I got that, and it was given to me in delivery price, then my interest in this move is even more peaked. I'm really interested in it. If it doesn't do it, I'll wait for more information because it might have a deeper retracement than I would have expected initially. And then I'll wait for a breakdown, and in having all these inefficiencies extended over, the market will refer back to them. And then all I have to do is wait for a bust to get there and then ride that thing down to Southern Town. And that's it, and be content with it. Okay. So another suggestion, and this is something you'll learn more about, Caleb, but for now, I want you to start measuring all the price swings that form. In other words, if it's moved lower, this is something you do after the fact. Okay. Don't try to do this while it's happening, but after the fact. Okay. And it'll teach you range finding, how far prices can run. You're going to take the fib and your high here. You're going to take that and anchor it to the lowest low at 7 o'clock. And this is what my Fibonacci settings are. So that way, if you've never seen them, you can see them now. And then you have 2.5. All right, so 2, which is 1 standard deviation would be about right here, and then 2 standard deviations. And then you got 2.5, which is usually like the extreme for like the wick purposes, where it can just get outside the range of what you'd reasonably expect. And that's kind of like a ballpark figure. Same thing happening on the 8 o'clock hour. You're going to take the fib from the high to the lowest low at 8 o'clock. All right, so we have almost all the lows in here. And then we have the Fibonacci at 9 o'clock. So the highest high at 9 o'clock that it formed thus far, and the lowest low up to 9 o'clock. And I have to go to standard deviation 1, it looks like. So we have this area in here, this area in here. Look how close in proximity that is. And then you have this one here starting at 7 o'clock. So these are all parameters without using like a thing like average daily range. We don't need to use anything like that. These are all ballpark estimates where it gives you a feel for how far it can reach mathematically. By itself, that's absolutely useless information. Useless. But when you incorporate it with real range, like we have over here, so we have below this low, that's definitely something that's possible. And if it really wants to be animated and go below that low, it can go as far as this level down here. And it got real close to it, but fell short of it. And that's fine. This is how far it can go, but where's the highest degree of probability where even if it doesn't go to that specific XYZ target, and that's the perfect case exit point, where am I going to come to the conclusion that this is an appropriate level for me to escape the trade and be content with that, even if it moves beyond it, and see if it still goes 200 handles past where I get out. I don't care because this was such a lion's portion of the move. I'm content with that. These are types of strategies I use. Okay, I look for the expansion below the underlying market structure, and I reference it with those specific elements of time. And I don't demand that they give the highest high and the lowest low. I'm looking for a convergence of these levels in agreement with an actual old low or an old high. It doesn't need to be relative equal highs or relative equal lows. It's just it's reaching for another a pool of liquidity. But for this model that you're learning, you're looking for relative equal highs to form after 7 o'clock or relative equal lows. And you're going to look for them to target that very draw on liquidity. And then as it goes to the next hour, if you don't have one or it worked off of one already, as it did here, at 8 o'clock, you wait for it again. And you measure that directional bias where it's likely to go. And if it is likely to go lower, your focus, your eye, this is the thing you're supposed to walk away with in terms of the learning today. Your eye jumps to all the sell side and balance buy side inefficiencies. That means the down close big range candles. They're all by themselves that I'm highlighting on. Your eye jumps to those. Okay. So when you're going back and you look at last week's charts and you do this every single day of the week, Monday, Tuesday, Wednesday, Thursday, and Friday, and we sit down on the weekend and we look at this week and you'll have last week. So you're going to show me 10 charts or 10 days of data. But all of this needs to be shown at the very lowest 1 minute chart. But referring to things on a 15-minute chart if it's salient, if it has some relevance to what you're looking for based on the rules I'm giving you here. But all you're doing is limiting your focus and highlighting, okay, it's likely to go lower and reach for relative equal lows, or it's reaching higher for relative equal highs. Once you determine that, you stick with it, even if it turns against you. This is the part that some of you are going to be uncomfortable hearing because you think it's going to work out perfectly for you and it's just going to keep moving and you'll want to go do demo trades or past funded account challenges or trade with real money because you think you've learned it already. That's a mistake. That's foolishness. Don't do that. What you're doing is you're sticking with an idea and a process. And my best model isn't 100%. My best model is not 100%. So I have to build in what? I have to afford myself the flexibility that I'm going to do it wrong. I'm going to be overzealous because if I've allowed social media, other people to be against my idea, the more folks that are like that, I get really excited about that. That's when I do get excited because I know I'm a minority in a move in the marketplace that I know has a huge degree of probability. And then I many times I'll try to out trade my methodology and anticipate the setups, which is why I stress to you don't try to anticipate a setup. Wait for it to be there because if it's really there, you'll see it. And contrast that with, well, I think it's going to go up. I just want to hurry up and get in there because I'm afraid it might run off without me, and I don't want to wait for the setup. And then you get in, and then it starts squeezing against you, maybe even trading back to a level you thought was going to be the entry for you, but now because you entered at a higher level, it's drawing money out of your account, and you're worried about that. Not, well, it was originally going to go to that level and get me in, but then you get out, or you put a stop loss in there too quick because you don't want to lose too much money even though that subconsciously You should have never took that trade. Okay, all those things are managed and prevented by doing what I'm telling you to do here. Don't worry about trading right now. Don't worry about entering anything. You need to be focusing on what is important in the marketplace right now. So if the market's going to gravitate lower, your eye jumps to only SIBIs. If you start seeing these SIBIs, that's these down close, big, large range candles, you have one here. You see that? And then I'm going to close it. We've had enough time today. And okay, we have the market trade up here. The bodies are pretty much respecting this inefficiency. The wicks go back to this SIBI that acts as an inversion fair value gap. And then we have this nice launch lower, disrupting all these relative equal lows here. We expand down through it, and then we trade back up to it, and it breaks lower, and then what does it do here? It disregards it. So now something has happened down here. So when you're looking at it spread out like it doesn't look so obvious, but when you do something like this, take a step back. This is something I learned from Larry Williams. If you feel like you're losing touch, zoom out or go to a higher time frame and step back away from your charts. Look at it from across the room, and you'll see that this looks very jagged. But when you're zoomed in real tight, it doesn't look jagged. But this is a disruption, and as I mentioned earlier this morning before it went below here, this would be a potential area to look for it to draw down based on any assumptions of this being a reversal pattern as I outlined with the breaker and an inversion fair value gap. But this right here is made jagged. Smooth, made jagged. So what will we do? We look for buy side. Buy side would be this high and this high in here. It trades above it. We don't really have a high to work off here because this is the highest one and it goes down as we go over here. So it's this high here. So this is a potential run on this high here. And that's something you can watch today, the rest of the day, and study that. And then once it does it, if it does it at all, you go back through the price action and you study what was there. And you pull out the points that you understand about what it is I teach. Breakers, fair value gaps, institutional order flow entry drills, inversion fair value gaps, mitigation blocks, and the whole thing, everything that you understand about it. And when you do that and you're identifying every single one of them you can see in hindsight, what will happen is because you're collecting these screenshots and you're expressing your observations in your journal, what will happen is your eye will start resonating with one particular entry model. What is an entry model? If you think the price is going to go lower, what is the catalyst that puts you in your trade? That's your multiplier. That's the thing you're betting on panning out. And based on where you're trying to get in at versus where the stop loss should be relative to that trade idea, you're trying to make a multiple greater than 1, okay, of whatever you're risking. And it need not be exorbitant. You don't need to have 2 to 1. You don't need to have 3 to 1. You don't need to have 4 to 1. You don't need to have 5 to 1. You just need to be able to see and anticipate fluctuations in price that are reasonable, and it gives you something to study, because the first lesson you need to know is how you're going to interact with that. As soon as it starts moving and it starts being quick about it, even if it only moves 10 handles, you're going to have a surge of adrenaline, and you're not even in a real trade. It's a demo trade. But because you're seeing something that you anticipated and it starts to run in your favor, that sense of accomplishment and satisfaction is very, very addictive. Which is the reason why you go in and you push another button on the demo. Oh, I'm going to do another trade. That felt good. Let me do it again. Let me do it again. Like someone's scratching your back, okay, or doing something else for you. You don't want to find your happy endings by over trading. That's not good, okay? Your happy ending comes by doing very little and being content with that. Just like we had over here, we had a disruption. We have a disruption down here. So where is their relative equal highs? Here and here. So what are we looking for? We want to see if it can muster the ability to poke its head above high of the day over here. I hate when it does that. Always jumps the last second. I gotta adjust it. So we have inefficiency here. This could be an immediate rebalance. Immediate rebalance is when you have a extended range or a candle that goes up and then it drops back down and just touches the candle high and then starts to run to an objective or liquidity or an efficiency, something like that. We also have this fair value gap here. In this case, I'd like to see this fair value gap stay open, not traded entirely down into that candle's high, and then reach up here. So these are all little drills and exercises you can do that will eventually lead to trade entries and trade stop placement and management. But more specifically, it teaches you expectation. The best measuring stick is being content with what you did, how you did it. You didn't hurt anybody. You didn't belittle anybody. You didn't try to measure yourself up against anyone else. And you don't concern yourself with those types of things. When you trade and live your life like that, you will have no drama. You'll have no spirit of competition that you have to live up to. You don't owe anybody anything. You don't owe dad any explanations for how you're doing it. You don't know anybody on social media an explanation of how you're doing. You have no reason to give anybody a testimony or update of where you are and how you're doing. But if you choose to do that, do it tactfully. Do it in a manner where it's disarming. You're not trying to make anybody else feel like they're inferior. You're not looking at anyone trying to say, I'm better at you. I'm better at this than you, or I'm going to be faster in profitability. Because I guarantee you there's lots of students out there right now that are going to try to race to consistently profitable with you. And that's a terrible, terrible thing to do because it's not a competition. It may take you longer than you already think it may take. And I want you to know as your dad, it's okay. It's okay. There's no rush. I'm not going to ever run out of interest in trying to help you. This is what I've lived for. I've wanted you to do this. And here you go. It pans out. That was a immediate rebalance. Immediate rebalance is here. It trades down, touches the candle, rallies up, and then we have a order block. It trades down into that and then expands up to there. So if you did something like that where I don't know now. I forgot where the what candles because I was so interested in talking, but nonetheless it delivered where we thought it would go. I said I wanted to see this stay open here because that would act as a breakaway gap, and then this should have been the immediate rebalance there. And then the next candle it rallies up, and then it's trading back down into this down close candle, which is an order block. It rallies up, it completely closes in this inefficiency. One more time, taps into it there, and then finally reaches up. I would absolutely be done. I wouldn't touch anything the rest of the day. There wouldn't be anything else I'd be interested in. And it could have all kinds of excitement right now. I wouldn't touch anything more. Why? Because we have traded down. We had a disruption, took out the sell side after we had a disruption here, and then we've come back and touched the high of the day. So I wouldn't want to worry about trading in the afternoon. I wouldn't worry about doing anything. I would be content with whatever it is that you've done, whatever you've collected today in terms of insight, experience, logging, encouragement, whatever that is, okay, it would be content and left right where it is right now. But I want to drop down into a 15-second and kind of tell you what I was talking about as we started this live stream. Let me go down into the 15-second chart. Let's highlight this first. All right, and then we'll make that green so it's highlighting. So here's the 5-minute price run in here, okay? And this is the immediate rebalance right there. So I'm going to draw a little line on that. And as you see, everything I'm doing here, it's highlighting it. It's highlighting it on the 15-second chart. Okay. And now we can take our attention over here. So I annotated everything that I was talking about and expecting on the 1 minute chart real time with you. And now we're inside this price run. So I'm going to talk about, and what I mentioned to my private mentorship the other day, this is the price delivery continuum theory, where you have an expectation where price is going to gravitate to, and it gives you a continuous opportunity for you to be a participant in it, because the markets are fractal. They're going to offer you setups on one time frame, and then that time frame has, once it's expired all of its opportunities that's used for an entry mechanism, you can't do anything else unless you're going to just chase price. I don't chase price. Okay, I'm going to show you how you can effectively and efficiently use a 15-second chart. Should you ever want to do so, you don't have to, okay, but you're going to find that it is very forgiving for traders that have missed an ideal entry. And or wants to, I'm going to say this, but please do not take this as an invitation to start doing it yet, because pyramiding and adding to a trade that's winning, that is very, very challenging for me as a mentor to teach that, because I already know that you want to do as much as you can to make money as fast as you can. You see all these people out here that have 15, 16, 20 accounts, and they're doing lots of withdrawals, pretty sizable withdrawals from trading all that. And it's important for you to be comfortable being consistent with small trades in the beginning, because if you can be consistent making small trades, you're building the mindset, you're building the the skill set, really. That's the best way of saying it, to adhere to rules and not chase extra money. As I was showing on the 1 minute chart, it was likely to come back down and touch the top of the candle and then start to expand up into this blue level. Okay, that was the initial high of the day, right at 7 o'clock in the morning, using the morning session. And if you look at what was happening here, it traded up and then came right back down. See that? What is occurring there? What's occurring here? It's coming right back down, and it's rebalancing the inefficiency of this quick sudden price run from this close to that close. That's what's occurring. So what the algorithm does, it refers back to that price point at that time, and this is what goes on. The market algorithm starts from a higher time frame and refers to key price points that are salient to where it's at right now. At given sets of time, as I'm teaching you here, it will refer to close proximity points of reference, and that means things like this, where we have a quick sudden run like this in a 15-second chart, in a 5-second chart, a 1-second chart. It's cycling through very, very fast. The mechanism of this, it's going through all these calculations so fast you can't keep up with what's actually going on. So when I had to sit down and create a language to try to compare and contrast the closest thing I can and not break any agreements, this is what you have. You have this visual representation of it, where it's likely to draw to this level and just above it. It comes back down, and where there's an absence of a fair offer for buying on a down tick. Okay, you ever hear how like when the circuit breakers go off on the market, when it goes too far one direction, there's a circuit breaker, they halt trading. Say, for instance, the market goes down too fast, too much at one time, and they pause trading until the market starts to tick up. Okay, there's a lot of high frequency trading algorithms that operate and engage in the marketplace like that. So they're filtering out they're not trying to buy when the market's expanding up. But what their algorithm seeks is these inefficiencies here. And then once they get inside that range, once it meets that threshold of trading into it, then once that's met, then it trades the first down tick after that. And then their algorithm fires entry orders to get long, knowing that the algorithm is repricing here. You can, if you have the benefit of looking at time and sales, you can look at how many contracts were traded here from here. That's not a lot of contracts. That's not a lot of contracts from here to there. It doesn't take a lot of contracts to move price. It just needs one contract to book and show time of sales. It's not volume that's moving price. Volume precedes price. That's a textbook right out of every retail language book there is. Volume precedes price. What does that mean? There's going to be a lot of volume in this area down here. Why? Because it took stops out. What's below here? Sell stops. So volume will be larger here than it will be in here. Because this is all discovery. This is all going to levels that are outside the range. And while there might be buy stops above this blue line that I indicated, the further above that line we get, the less volume there will be, because everybody wants to have a stop loss real close to a level. And it's thinner as it gets up here. And that's why you start to see the price start having all these big gaps, because it's pressing higher and higher and higher. The algorithm is just going to reprice higher. Whether you want to be a buyer or everybody collectively wants to be a buyer or not, it's programmed to keep offering that price, because someone is always coming in with a sell order at market and a buy order at market. And guess what that does? It gives you the counterparty, and it's going to book price. You can sit on your hands and talk about how you're not going to buy it because it's this, that, and the other thing. There's always some market orders coming in. Always. And the algorithm knows that that function of liquidity is always present. So it will constantly offer higher prices, and it doesn't matter how many Tom, Dicks, and Harrys from Goldman Sachs, okay, or, well, I like kicking them around. We'll just leave it at that. All these large investment firms, no matter how much volume they got or they're trying to push into the marketplace, they're not pressing price down. So buying and selling pressure is not it. Okay, it's time and price. So in here we have price dropping down to overlap this inefficiency. There's no gap in here, is there? Is there any gap in here? Sure there is. Look. I'm not Chris Laurie. When there's a inefficiency, if it comes down and closes it in, I'm not done with it. Relative equal highs. Here, fair value gap. It trades outside of it, comes back down into it here with a 1 minute immediate rebalance. So it's trading down to a deeper discount. So this is your first return in after taking the buy side here, but this is left intact. So this is still in play. So it's dropping down. That right there would have been a 15-second long for me. If I would have been buying down in here, or if I was long here, this would be another area where I could go long and add another partial. But it couldn't be larger than one contract. Why? Because we're long in the tooth with the price run, and my limit order would be just above here. It wouldn't be up here. Oh, ICT, you should have been looking for something like that. But why? The low-hanging fruit is just above here. That's all I want. That's where the largest degree of volume is going to be, because the order is going to be closer to the levels that are expected. The algorithm is going to reprice because it's going to do the function of what a wick does, where it does the damage. It colors outside the line, just like your son or daughter will. And she's doing exactly what she's coded to do. But I need to be efficient with executions and remove the element of fear and greed and regret. So I'm going to take where it's obvious for me to get out. If you start getting out at the highest high and getting in at the lowest low all the time, you're going to experience broker problems. They're going to slip you. They're going to do requotes, and you're going to miss. Because if they've been B-booking you, and you'll know they've been B-booking you if you start getting that kind of stuff and you're winning, then they'll start messing with you because you're taking money out of their hands. You can get mad about it all you want. Oh, it's wrong. It doesn't matter. You gave them permission when you signed up. It's the way it is. If they can get you out with the liquidity, then they will, but they can't guarantee it. So there's their gray area. So the 15-second chart, when you see things on a 1 minute or 5 minute chart, it gives you opportunity for you to get in alignment. Now, let's just say for sake of argument, when I was calling the 1 minute institution, 1 minute immediate rebalance and expecting it to run up here. Okay, that is a 40 handle run or more. The live streamers on YouTube, most of them don't see that. They get out with like 5 handles, 15 handles, 10. They might say they're aiming for 20 and they get out at whatever their emotions push them out of the market with. And you never really see them enter. You don't see when they're actually telling you this is where it's happening right now. They have a target that's a lofty one. They'll say, I think it's going to go up here. And then they'll say, well, see, I called it. Who's doing it like us? And they show you the trade after the fact. They do that because they don't do what I'm teaching you to do right here. And they're going to start doing it. Trust me. And then when they do it, their trading will improve and they'll get more confident about pushing the button at the execution points from beginning to end. And then they can earn the title of #1 day trader on YouTube. But until they do that, they can't. So let's say I missed this opportunity to be long there. Okay. We have a down close candle inside of a fair value gap that came back down into an old inefficiency as well after the first run above here. This is all extra credit stuff. Okay, so this is more or less not for you, Caleb. It's for the people that are familiar with my stuff, but just want a little bit more icing on the cake. When it trades back down into this down close candle here, that could be a buy for me as well. That one. And we can look at this little gap right there. See that? That's all it takes. It trades down to here. My limit order would be just above midpoint of that wick. I'm not demanding it gets me filled in there because I may not get it. So I'll be a little bit more forgiving in placing a limit order there. And then I could use that to get in sync with the run if I felt like it was going to go higher. I'm just teaching on the basis of how to use the 15-second chart and how it gives you a plethora of entries. There's so many entries offered on a 5-second and a 15-second chart that you don't see in a 1 minute chart. But the algorithm's doing the same thing. You're telling me that people are looking at the chart and they're looking at reference points that I've classically defined now as PD arrays. The market keeps going back to these price points. You mean to tell me everybody that learned from Online Trade Academy and supply and demand that they're all looking at 15-second charts and they're stopping the market right at these levels? Their buying is stopping it right at those levels and it's keying off of that stuff precisely. You're full of shit. It ain't happening, Jack. It's all algorithmic. And it doesn't matter how many buying and selling of specific number of contracts, the price is going to go where it's going to go because it's scripted. And it's going to go there based on time. That's the way it works. The 15-second chart affords you that as a mechanism, okay? It also gives you the ability to reduce your stop loss, okay? Make it a little bit tighter. Not that you should be trading with really early small stop losses in the beginning because it's important for you to read price appropriately and effectively and efficiently first. And then eventually, when you're into the part of taking trades where you have to manage real risk and real money, then these types of conversations are much more pertinent to the discussion. But right now, it's so outside the scope of what Caleb needs right now. It's not important at all. It's absolutely zero importance, zero. But I wanted to kind of like outline something real time and give you a feel for how you can make bread and butter setups. And they're real easy to see. Like if you understand where the draw is, what it's done, it made something jagged down here, and it made something jagged down here, and it left that high and this high in place. It's relatively equal. When you have the chart spread out like this, it doesn't look like that, but when you compress it, we're back in the same discussion of, okay, it failed to get back to that one. So the second one was lower. So what does that mean? It's a high probability relative equal high. The market will reprice to that because it wants to disrupt. It wants to disrupt. It wants to be that cousin or in-law that comes to the cookout that you really don't want there. That's what the market does. Okay, and when you understand that, you'll do better in your trades. But I've gone on and on today. I've really overstayed my welcome. I'm tired. I'm hungry, and I want to get off here. So hopefully you found this one insightful. If you did, I would appreciate a thumbs up. It doesn't mean you love me. It just means that you learned something today, and you're continuously getting a deposit in your understanding. And that's like a report card for me to either continue or not. If there's 100,000 people watching and there's less than 17,000, that's going to be very discouraging. I might take tomorrow off if that's the case. So I'll let that be a little factor in whether or not you want to give me feedback. Until I talk to you next time, be safe.